1040 US individual tax return 2020, line number 8, other income from schedule 1. So we go to schedule 1. Okay, that's great. Now schedule, here is the schedule 1, right? Now schedule 1, other income, there could be different type of other income, right? It could be schedule C, it could be alimony received, it could be taxable refunds, right? But and it could be rental income, rental real estate, royalties, partnerships, S corporation, trust, that we have already discussed, right, in previous sessions. So but these are the income. Now if borrower is receiving rental income, or he or she have different properties and getting some rental income, getting some, they have the properties have been rented out by borrower, they are receiving rental income from there, they are going to show that amount here along with other income, right, partnership. So we will, whatever the amount written, let's say they have written here the uh, 3000 income. So I cannot make out ki 3000 income is only related to rental income, because there are other income as well, right? So they have lumped all the income received from royalties, partnership, S corporation, rental real estate in this column, right? 3000. So I cannot, I mean, if what is the rental income, what is the portion of rental income out of this 3000, I need to go to what, attach schedule E. So what income, what is the source of this income, I need to go to schedule E. Let's go to schedule E, right? So here is the schedule E, and it is going to give us a different part 1, then part 2, then part 3, and part 4, and part 5. When it comes to underwriting calculations, mostly we will be more, our focus is going to be on this part 1 and part 2 mostly, because that is what mostly we will be receiving the income from. So our focus will be mostly in the schedule E, part 1 and part 2. Part 1 belongs to the rental real estate. Now when we saw in the schedule 1, there was a 3000 income that has been lumped in this column, right, in this line 3000. Now we come to schedule E, and we are looking at the first part. There is a possibility all that 3000 income has been retrieved or has been earned by borrower from this part only, I mean rental income only. There is a possibility borrower doesn't have any business income, only the rental income. Let's see. So let's see how to calculate income, what to verify in income. Okay, so it could be the name, like anyone, maybe you are underwriter, so let someone has the name and it's underwriter, right, and their social security number, whatever it is there, right? So maybe, okay, just a hypothetical number, don't go by the number. And then we will skip the part, A and B, these are just line. If you want to read, you can read out those lines, not very much related to underwriting. So we will go to the 1A, line number A, physical address of the each property. Each property means there are A, B, C, 3 lines are there. So we can add, if someone has 3 property, they can write all 3 properties, or if someone has more than 3 property, they need to include, they can add only 3 addresses in this page, and then they have to add one more page, one more similar page, and there they are going to disclose the other properties. See addresses. What are so the addresses? It could be like property number 24, then city, state, and zip code. Now the property number 2, okay, let's see, property number 2, 12, okay, and city, state, and zip. This is how the address is going to be. Now then the, see, maybe borrower only have 2 properties, okay, and there is one plot, it could be plot number 6, city, state, and zip. Good. Now let's, these are the just addresses. Okay, now we are coming to schedule and we are able to see, okay, there are three properties borrower have: property 24, property 22, 12, and plot number 6. Okay, plot number 6. Okay, let's see what is 1B. 1B is type of property. I mean, what type of these properties? Now tell me how many types of properties there are. Any idea? So there are different property types that have been written here. What are single family residence? Number two, multi-family residence or multi-family residence, vacation, short-term rental, commercial, land, royalties, self-rental, and other. If other, then describe here. Okay. So let's stick to the number till number 7. So these properties will need, what is the type of these property that need to be written. So line A property number 24, it could be number 1. So when it comes to number 1, that means I can easily identify, okay, property number 24 is a single family residence. Easy. Number 2, maybe number B in the B line, they have written number 2. I can easily identify it's a multi-family residence. Number 12 is the multi-family residence, or it could be again number 1 only. Okay, it's also SFR, or it could be vacation short-term rental. That is a possibility. It could be vacation short-term. So we can easily identify what type of property borrower have those type of. Let's stick to the number 1. The second is also the single family residence only. Okay. Number 3, what is this property? Plot number 6, city. So there is a land also, right? It could be land. You can rent your land as well, right? So they are going to write. Number 5, someone may have, you know, rented out their land. They didn't property. They didn't build any property on that land, but land itself has been rented out to someone. So that there is a possibility they can receive, or they can, it could be royalty as well, income. They are receiving some royalty from a land or any other asset. So they might write the number 6, that they are receiving royalty from there. But we always need to, before starting calculation, calculating income, before doing that, we always need to verify what is the type of income, whether we need to consider that there could be different guidelines. So always, it is always good, before moving or before doing any calculation or before considering any rental income in the loan, always try to identify the property type, what type of property. Good. Now on the right side, fair rental days. That means how many days property has been rented out. So mostly it is going to be 365 or 360 or 300. Let's see both properties or all the properties have been through rented out throughout the year, or maybe one was only for 300 days. And then personal use days. Obviously the property was the entire year, it was not rented out, so there won't be any. And it could be like they use this land for some time for them, and then they rent it out. So it may be 65 days they used. Now we are moving towards the real section, and that is real. Number 3, rent received. So if the number A, again A, this is the A, this the A, and the A. So all these A's are related to only one property. So what is the A property? Property number 24. What is the type is 1. So what we are going to receive? We are going to receive the rent only, because that's a single family residence. So maybe the throughout the year they were rented out for 365 days. So what is the total rent in the year they received? It could be like 12,000, right? And B, or we'll go to the to B property later. First we are going to royalty. No, there is nothing. It is rent. Now straight away it is going to expenses. Ki, okay, if you have a property, you have received some amount as a rental income. Obviously, there could be some. There is going to be expenses. So maybe to rent out the property you advertised, right? You spend some money on advertising. If you have, they will be writing here auto or travel related expenses. Then they need to be cleaning and maintenance. Maybe let's say $300 someone may have spent. Commission, no commission. Insurance of the property. Insurance, we know that property will always have an insurance, so it could be month entirely throughout the year. What is the total premium they had to pay? It could be like again 600. Okay, total premium for the year. Mhm. Legal professional fees, if somebody paid the management fee. Mortgage interest, now if property in mortgage interest, if property will have a loan, obviously they will be paying the mortgage interest, right? So what is the mortgage interest? This is almost 3000 mortgage interest. Good. If other interest, repairs, if supplies, if utilities, or depreciation. They are saying okay, no, property is actually depreciating, I think. Okay, taxes. Okay, the numbers taxes will, property taxes obviously is going to be, so let's say it could be 1200 taxes. Total yearly taxes, that utility, depreciation, we know depreciation expense or depletion. So obviously there will, property will depreciate each year, right? So they might say कि, okay, I'm going to take 1000 as a depreciating amount. Ki property is depreciating 1000 per year. Now the total expenses, what are the total expenses? 3, 6, 39 and 51 and
61.
6100 is the total expense. Nice. Subtract the line 20 from line 3. So where is the line 20 is 61 total, line number 3. What is the amount going to be here? 59.
5900.
So 5900 is the amount we are going to write here. These were the expenses and this is the profit they received. So deductible rental real estate loss after limitation, if any. If there were any deductible rental real estate loss after limitation, so they can write here on 22 deductible rental real, anything that need to be deduct, they can, it could be written here. Now the number 3, total of amount reported on line 3. So it is here they are going to write the total amount, right? So let's go to now till here. These were the expenses. So total benefit they received from this property is 5900. Let's go to B. What is the B? B is again a rental SFR property. Very good. So they are going to receive rent. Maybe it's a bigger property. They may have received 24,000 here. Now the cleaning and maintenance, they may have spent, it's a big property, so may have spent 1000. Insurance, yes, big property, insurance is going to be higher, maybe 1200. Okay, mortgage, yep, mortgage they have paid 6000 almost. Interest and taxes, big property, so maybe 3200 is the taxes. And depreciation, again they are claiming 1000 is the depreciate. Now what is total expense? 400.
15400.
Nice, great. Okay, now the let's go to the third property, C. C is what? Land, right? See, land, they may have given a land on the rent. So they may have received 1200 from the land. Now cleaning and maintenance, they may have given $200 for cleaning spent. Now what would be the insurance amount here? Do you think someone is going to take an insurance on the land? Tell me.
No.
No, no, sir.
No one is right, so it
Yes.
will be zero. And somebody purchased the land and took the loan, then there is a possibility, but I hardly see that. Okay, so taxes, yes, property taxes is going to be there always, right? So they may have to pay 1200 as a, or maybe 1000 as a property tax. Okay, depreciation, there is no depreciation. Other, so this is the total expense. What is the total expense? Oh, it's so let's say total expense is 1200, right? Sorry. Yep. So total expense is 1200. So what is going to be the total income? Zero. And here
400 होगा सर ये बी वाले में 15400 चाहिए और 12400.
Yes, sir. 12
12400.
हम्म.
Okay. So now 11,600 is the income, right? Great. Okay, now let's see. This is how we will be receiving the information. This we are not, I'm just to tell you how they are going to fill, but it will be this schedule, it will be already filled up, will be updated with all this information. So then total of all amounts reported on line 3 for rental properties. So all three properties total amount reported on line 3 you can add here 12. Right. 3600 and 4800. So total 4800. That is how it will reflect. Number B, line 4 of the royalty property. We don't have royalty. Total amount of line number 12 for all properties. Line number 12. There is the total of all amounts reported in the line number 12. This is the line number 12. So 3000 and 6000. So how much? 9000. We can write 9000 here. Okay. Now total of amount reported on the line number 18. Depreciation. I thought it was 12,000. So sorry. Total of all amounts reported on line 20. Where is the line 20? Total of. Now what is the total? Let me know it. 6100 plus 12400 plus 1200. 1917. 700. Is that fine? Okay. Income. Add positive amount shown on the line 21. Do not include the losses. So 21. Add positive amount. So 51, 5900. Only positive amount. So we have both the positive, no negative. 17500, right? So here 17500. Great. Now here they are writing add royalty losses. No, we don't have royalty. Okay, that's great. Now, so. And now total rental real estate royalty income or loss. Combine line 24 and 25. So line 24 and 25 is same. 1705. 17,500, right? So this is the total from all three property, land and property. This is how it is going to look like. This is how we will be receiving. Now what we are going to calculate income, right? Remember, for the government loan, especially for FHA VA, right, there is a different formula, and to calculate income for the conventional there is a different formula. So as I told you, what the income sheet, it is a form income or calculation worksheet that is known as 1038 FNME 1038. You can easily find it on the Google, right? And you can download and utilize this Excel worksheet to calculate income. Okay, rental income worksheet, individual rental from investment, right? Documentation required. What documents? Schedule E, IRS 1040 or lease agreement or FNME 1007 or 1025. We'll discuss this later as of now. So enter here, we are going to enter the property address. What was the property address first? Property number 24, right? Other. The second was property number. What was the second property? Property number 12, right? And third was the plot. Do you want to write the plot number? You can write plot number 6, I think. Okay. Rest of the address is going to be the same. Okay. So this is how we can calculate, four properties in rental income altogether. So we have three properties only. So let's calculate for three only. Now let's come to this total. Enter here, we are going to write the similar A, B, C, D. So we have three properties here, A, B and C. Enter total rent received. What is the total rent received for the property number 24? Remember, total rent received, it was 12,000. Let me show you 12. It was 12,000 or how much? 12,000,
Yes. Yes.
right? Then, okay, let me do Okay, let's do it in this way. Okay, so 12,000, and then what next? Enter total expenses. What are the total expenses?
6,100, sir.
Very nice. 6100 is that total expense. Now enter insurance expense. What is the insurance expenses? What is the insurance? Line number 9, 600.
Yes, sir.
Okay. Enter mortgage interest paid. What is the mortgage interest paid? 3,000.
3,000, sir.
Great. Okay. Total tax expense. What is the tax expense? 12,
1200.
1200. 1200. Great. Enter homeowners association dues. Do we have homeowner association dues? No, right? It will be mostly written in the line number 19, other statement number 10. Okay, now, and they have written some amount here, $300. Now we do not know whether it could be HOA, it could be $100 for HOA and $200 for other expense. Then we need to go to statement number. We need to find that statement, that page number, right? It will be written statement number 10 in that page. We need to see that statement, and there it could be like HOA 300, or it could be like union dues for $100, and the HOA is $100, and some other charges are $100. So we can go and calculate, or if it is something that need to be added back, we can add back. Okay, but we are assuming that we do not have any HOA, association dues, properties, SFR. Enter depreciation expense or depletion. Do we have any depreciation in this? Yes, 1,000, right? Enter any one time extraordinary expense similar to the schedule C. Remember schedule C, there was a, if there is anything that is one time in the property, so there could be like some repair that has been done in this year, but that is not going to be next year. That is not a recurring expense, right? So we can add back $600 or $6,000. This time had been window was broken, and that was, you know that was that was an expense. But we know that window is not going to, not going to be broken next year, so we can add back that. And then enter the number of months of the property was in service. How many months property was in service? How many month the service was in, property was in? Step 1. Okay, so here we need to write 12. Then, I mean, how many times the property in service we need to write here, right? So 12. So it will automatically show this is the equal adjusted monthly rental income is going to be 975. Now enter proposed PITIA. Proposed PITI means we need to go back to our uh, LOS, or we need to go back to our document, and there we need to see like in 1003. If you are working in live underwriting, obviously you need to go to your LOS, and from the that property expense column, proposed expense, total proposed expense for the subject property need to be written down here. So it could be like proposed expenses could be okay, the new payment, new EMI is going to be $1,500. If new PMI is going to be $1,500, it will be the, what would be the total income from this property? It would be a negative amount. But if it is, let's say, new EMI is $800, but you will be having $175 per month and positive income. Okay, let me go to my whiteboard, and then we will see what is happening here. Okay, property number 24, which we were just looking at our example, right? In the tax return schedule. there was some amount that was coming, like 12,000 was the total income borrower was receiving in the previous year. Entire previous year borrower has received 12 12,000 income, right, from the property number 24. So according to this, if we are going to see at this income, rental income, what should be the per month income? 1,000. If we are going to divide it by 12, then 1,000 is the total income, right? That is what simple method. 12,000 divided by 12, total income received in the year 12,000. So monthly income is going to be 1,000. But I cannot say ki this is the monthly income. Why? Because there are expenses also going to be involved in this property, right? In this property, the proposed expenses are going to be like there would be an EMI on the property. That is, EMI means, what is the EMI? PITIA. PITI means principal, right? Is the principal, interest, taxes, property taxes, and insurance, and association dues, right? So HOA, homeowner association, all these, this is what PITIA or PITI becomes, right? So this is what the EMI. So whatever the PITI is, that need to be excluded, then only we will get to know. Let me give you an example. I'm going to purchase a property, right? I'm going to purchase a property from anyone, and they are telling me ki per month you will be receiving 1,000 income from this property. So I could see, okay, I'm going to invest some money on this property, but they are telling me the 1,000 rent I'm going to receive, but how much I am going to pay per month? 1,000 is fine, I will be receiving as a rent, but how much I need to spend? I mean, there, that property, I might need a mortgage on that property, right? So I will be taking a loan, there would be an EMI on that property, and plus other expenses as well, right? And after that only, I will be, whatever the amount remains behind, only, the balance after paying all these expenses, whatever the amount remains behind, that will be my income. This 1,000 income is not going to be my entire income. 1,000 charges I am receiving, but how much charges I am paying? Whatever the charges I am paying for per month for that property, of what, after deducting those charges, that is the my income. That is going to be my net income. And what would be the charges? Principal, interest, taxes, insurance, and HOA, if there that exists also. Let's not get into the HOA, right? That will be there, but mostly, let's see, it's SFR property, no homeowner insurance, association dues. So principal, interest, taxes, and insurance. But if somebody is paying, let's say ki principal and interest itself is almost $800 per month, plus taxes is $100 per month, plus maybe $100 is, or 200, insurance maybe $100 is the insurance. What is the total amount? 1,000, 8, 9, and 100. 1,000. Is there any income from this property? No, there is no rental income. 1,000 that borrower is receiving from the tenant, and 1,000 borrower is paying. So there is a zero, not negative, not positive. But if, let's say, the borrower is paying 1,200 as a principal and interest, plus 100 as taxes, 100 as insurance, so it will become almost 1,400, right? Total expenses per month is 1,400. Now 1,400 minus 1,000 is the rental income. So what is that? minus 400 is per month. So this is what we are going to say negative cash flow. This property is giving us a negative cash flow because I'm spending for 1400 per month and receiving only 1000. So that is how I'm going to make out whether this property is going to give me a positive cash flow or negative cash flow. In the other case, let's assume ki property has maybe received 24,000 throughout the year. This is the income they received in the previous year, right? So 24,000 divided by 12 means 2,000 per month. In that case, 1314 total payment is 1400, rental is 2000. What we are going to remain, what is going to remain behind? Almost $600 per month. So this $600 is going to be my positive cash flow. Positive cash flow or positive income. Positive cash flow from the property, right? In this case, 600, I will be having a positive cash flow or having a benefit of $600 per month. I hope that it is clear to everyone, right? The simple method that we just saw. But when we going to the tax return, what we are going to do, or especially for the conventional loan, how we are going to calculate? We are going to calculate the net income from the previous year. What was the net income from the previous year? And then we are going to deduct from the current year PITIA, right? Total income they received 24,000 in the previous year. Then we are going to deduct expenses. So maybe they have received, they spent on cleaning, right? That we saw cleaning dollar 200. Then insurance, property insurance was dollar 600. And there could be mortgage interest, that was dollar 3000. And taxes, property taxes, that have been paid almost 1000, right? And then there could be like depreciation is like dollar 1000 again, right? So what is the total expenses? Total expenses are 8 38 30 4000 5000 and 58. 5800 is the total expense. So what is the tentative profit? 5800 minus 24,000 minus 5800 was received in the previous year, right? This is the total income they received in the previous year. That according to this was the total income. This is the net income, I would say. This is the net income. So total they received 24,000, and out of this 24,000, these are the expenses, and this is the net rental income, $18,200. Okay, now what we are going to do, we are going to add back the insurance, mortgage and taxes back and depreciation back into the this amount, right? Remember, insurance, mortgage interest, taxes and depreciation, we are going to add back. We are always going to add back this amount in the net income, and then we are going to consider the income. So what will be happening? The net income received is $18,200. Now add back what? Insurance 600, plus add back mortgage interest that borrower paid now, plus taxes. How many taxes? 1000, plus depreciation. We know that depreciation always we can add back. So what is going to be? It's going to be 23,000, right? 800. Is that so? Right? $3,800 is the total income they received in the previous year. Now, from this income, we are going to deduct the current year PITIA. right? Current year PITIA, PITIA. That I was just showing you what how need to be done. So this income now minus divide by 12, right? Just divide it by 12, divide it by 12, and what is the income going to be? This is the monthly income borrower will receive. According to this would be the monthly income of borrower. Now, this is the income, but in the current year, I mean borrower will have expenses as well. So those expenses, current year expenses need to be deducted. Always need to be deducted. What could be? It could be maybe $1,500 per month, right? Current year PITIA. So 0.33, right? 3, 8, and 4. So 483 is going to be the borrowed positive cash flow, right? So these items always need to be added back. Now, let's say we are calculating an income. We are calculating an income for a property, right? For other property, like borrower has 2 3 investment property, we are, whenever it's a conventional loan, first we need to go to the schedule E part 1, right? And then whatever their net income, we need to add back all these insurance plus mortgage interest, then taxes and depreciation plus HOA, if HOA exists there. Then all these expenses need to be added back and then divide by 12. After whatever the net amount comes, just deduct the current PITI, current year PITI, and what if it is in the positive, it is a positive cash flow, it will go to our income section, right? It will always become a income or from the for the borrower positive cash flow. And if it is a negative, obviously it will get added into the with the property as a negative cash flow in the liability section. If this amount is negative, it will be a part of liability section. If it is a positive, it will be a part of income. Is that fine? Okay. Now let me come back to my
If you do
workstation.
not have taxes and property bill for this property, then we know the but was the previous year tax insurance, right? So insurance and taxes could also be considered from this for this property, not for subject, only for this. If we do not, however, we should ask for the current year tax bill and current year insurance for all the properties, all other properties, those are investment. But somehow we didn't receive for any property, we are good to consider this amount from here as well. The second thing, as I told you in my previous sessions about the credit report, if we sometimes you might receive a you know uh, property and borrower is stating in the 1003 in the application that property is free and clear, that property is free and clear. What is the first document we are able to see whether property we are able to prove as an evidence, with an evidence that property is free and clear? The first document is the insurance. Remember what happens in the insurance? There is a mortgagee clause, right? So we can go to the insurance, and if there is no mortgagee clause, that means there is no loan existing on that property. Clear. If we do not have HOI, we can come to this column. If that property is on rent and borrower has claimed rent on or has disclosed the rent, mm, uh, that property on the part 1 of schedule E, we can come to this section, and here we can see, okay, there is no mortgage interest, that means property has no mortgage or no loan on the property. Does that make sense? Right? So
Yes,
there are,
sir.
we have
Yes,
this.
sir.
This is the second proof that we can justify. Okay, previous year tax return does not show any mortgage interest paid on the property. That means property does not have any loan and it's a free and clear. Great. After calculating this, whatever the income, like after calculating the income, whatever this outcome is, we are going to take it as it is in our loan. Are you guys with me?
Yes, sir.
But whenever someone is not able to show us the income on their tax returns, when they will not be able to show us income in their tax return, if they are purchasing that property or they recently purchased the property, maybe, right? There is a possibility that somebody recently purchased the property, right? So in that or they might tell us ki, okay, the tax return has not yet filed for this, for the previous year. I took the extension. So in that case, they might give us the lease agreement. And those are also acceptable if they can prove 2 years of history with lease agreement. That is fine. Or if the property has been purchased only recently, then that could also be fine. Okay. Okay. Now, whenever you are going to consider income from the lease agreement, how to calculate? Very easy. Enter the gross monthly rent from the lease agreement, monthly rent, whatever it could be $1,000 per month. Okay. So if lease agreement is showing us that 1,000 is my monthly rent, I can put that 1,000 here. The remaining 25% account for vacancy. We are not going to do, means I told you whatever the amount received in the disclosed in the tax return, we will be taking that amount as it is. We do not need to do 75%, or we are going to consider it 100%. But whenever we whatever the amount, monthly amount we are receiving in the lease agreement, we will only be considering the 75% of that amount. Okay. Okay, so the remaining 25% account for vacancy loss, maintenance and management. So that is why we are considering only 75% of the income that we receive from a on a lease agreement. Enter PITIA, whatever the PITIA for subject property or existing PITI for non-subject property. So whatever the similar case in above, like here we had received $1,500, whatever the current PITI, current year PITI. Okay, now 1,000 is receiving, we took the 750 only. So now 1,500 is the current year EMI. So it is going to be a negative cash flow. Monthly qualifying rental income, it is a loss for 75, or let's make it $800. Then it is only 50. Now see, we could see 1,000 is the rental agreement, but since we are only considering 75% of that 1,000 income that is given on the lease agreement, so it is still, and 800 is the PITIA, still that is the negative cash flow. But if I'm going to make it 600, then it will be 150 as a positive income, part of the positive income or part of the income. Are we good with this? It's very easy, right? Okay. And then determine the qualifying impact using the result 2 and VA. So whatever the properties you have, that will be the total amount will be coming here. I will be sharing this with you, or otherwise it's very easy. You can go to website, Google, just type the FNME form number 1038 and you can get always practice.